Well, hello, everybody, and welcome to our annual webinar for accounting faculty. We hope that your fall semester is off to a great start, and we're very pleased that you're able to take time out of what I'm sure is a very busy start to the semester to join us today for this update on FASB's activities. We do have some housekeeping items that we'd like to cover off first, and so I will pass things over to Jeff Mechanic to take care of that for us. Thanks, Jeff.
Yeah, thanks, Christine, and welcome everyone. I actually have to make a couple of verbal tweaks to what is on this slide. We recently changed platforms for delivering our webinars. They're now being done via Zoom, which many of you are already familiar with. The slides can no longer be found in an event resources tab because there is no event resources tab on this platform. Rather, there are on our website. In the chat, I think we put in shortly a link, a little while ago, a link to where you could find them. But let me just verbally describe just in case. It's on the FASB's website, fasb.org. There are a series of drop-down menus. This is the menu on the right-hand side on news and meetings. And then when you use that drop-down menu, you'll come to a line that says educational webinars. And in that line, when you click on that, you will find the deck. And we've put the deck into PowerPoint format for you. We encourage you to use the slides or some of the slides in your teaching as you see fit. And we hope that putting it in PowerPoint rather than PDF will help you in doing so. To ask a question, there isn't an ask a question box on the left-hand side of the screen, but there is a Q&A feature in Zoom, probably on the bottom of your screen. And that's where we ask you to put in your questions, and we'll be answering them during the course of the webinar. And finally, a reminder to turn off your pop-up blocker. Move on to the next slide. Well, besides Christine, also joining me today on screen are Nellie Debler, who is the FASB's Deputy Technical Director, Derek Christensen, who is the current postdoctoral fellow here at the FASB, and two of our terrific project managers, both of whom are involved in our academic efforts. And those are Jill Switter and Lauren Motley. But I also want to give a special shout out to somebody who will not be on screen, but who's helping us in the background. And that is Rose Hartnett, one of our awesome postgraduate technical assistants and a proud Pitt grad. Derek will be telling you shortly a little bit about our PTA program. Again, thanks Lauren, thanks Rose for your help here. Let's move on to the next slide. A recording of this webcast will be found on our website, can be found on our website, that same educational website line under news and meetings. And it'll be on our website for the next 6 months. However, please note that CPE credit will only be available for the live viewing of this webinar. It's not available for those of you who watch the archive program, but again, it is available that as a resource to you on our website, that archive. If you have any questions about this webcast or any of our other educational webcasts, please contact the FASB at cpedirector@fasb.org. And then finally, CPE credit is available, as I mentioned, for viewing this live program. Today's program will be worth approximately 2.5 hours of CPE credit. The CPE credit, however, is not available for group viewing. You need to be individually logged in order to be able to receive it. And you also have to satisfy a few requirements. You have to stay on for the required number of minutes. We'll be on for a little bit over 2 hours here. You have to stay on till at least 3:05 to be able to get the 2.5 CPE hours of credit. And you have to respond to polling questions that we'll be asking. You don't have to answer all 11 that we put on. You can miss a couple of those, but you do need to answer, again, most of those in order to get the credit. And then finally, we ask that you complete the course evaluation at the end of the program to help us in our future webinars. With that, we now have our first polling question, which I'll ask be pushed out. It's a polling question where we're just asking some information to help to get to know our audience a little bit. So this one is, what's your current place of employment? And choose the one that best answers that. While you're answering, I want to tell you about the FASB's electronic newsletter that we call FASB Action Alert. It is available free of charge, and you might find that to be very valuable. It keeps you up to date on upcoming meetings issuance of documents and other noteworthy news items. To subscribe to that, you go to the FASB.org website, to that same drop-down menu that I mentioned a little while ago on news and meetings. There is a line at the bottom of that says contact us. And when you click on that, you'll see that there's a button to subscribe to the action alert. So very important resource. And if you didn't already know about it, you now do. Encourage you to subscribe to it. With that, I wanted to let's see if we can perhaps push out our answers here. And it's a nice mix. We have folks from private institutions, from public institutions, from community colleges, a few here and there from international educational institutions, and some others who again, we're pleased to have all of you with us here today. With that, I'm going to turn it back to Christine, who's going to tell us about our agenda.
Wonderful. Thank you very much, Jeff. So today's session is intended to just touch briefly on many of the topics that you indicated when you registered would be of most interest to you, starting with changes to the membership of the board and the functioning of the Emerging Issues Task Force, as well as an update on the PCC's activities since last year's webinar. We will then provide an overview of several of our initiatives that are intended to support the production of relevant research and our consumption of that research and standard setting. We'll follow that up with an overview of our technical agenda and our chair's research agenda. And then we'll take a deeper dive into the recently issued measurement chapter of the conceptual framework, several projects that are on our technical agenda, and several recently completed projects. Now, along the way, if you have any questions, I'll just reiterate, please type them into the Q&A box. We will do our best to address those as we go, and often when we stop for polling questions, we'll use that time while we're waiting for you to respond to the polling question to respond to your questions of us. So now let's dive right in with an update on the board's membership and the EITF. So as many of you know, Jim Croker's 10 years on the board came to an end on June 30th, and Jim was replaced by Hilary Salo, who joined us as the FASB Vice Chair. Hilary has certainly hit the ground running since she had been FASB's technical director for the past several years. And prior to that post, Hilary was a partner at KPMG. The next person to roll off the board is going to be myself, June 30th of 2026. And the foundation will be issuing a call for nominations in early 2025. Now, while there is no guarantee that the next appointee will be an academic, if you know someone who would be a good fit for the role, please be sure to nominate them at the appropriate time. Next slide. So Hilary's position as technical director has been filled by Jackson M. Day. Jack and Rich know each other very well, having worked together for many years at EY. Jack is a past deputy chief accountant and was the acting chief accountant for a time at the Securities and Exchange Commission's Office of the Chief Accountant. Jack is also a past practice fellow at the FASB and has served on the EITF. So I also wanted to just share with you some of the recent changes to the Emerging Issues Task Force. FASB Chair Rich Jones reconstituted the EITF earlier this year, including appointing 11 members to the EITF, many of whom are new. And in addition to these 11 members, the FASB chair also attends the EITF meetings, and the chair of the EITF is now the vice chair of the FASB instead of the FASB's technical director. The process by which the EITF's agenda is set has also changed. The EITF's agenda is no longer set by a majority vote of the board. Instead, the EITF sets its own agenda through its own agenda setting committee. External stakeholders can submit agenda requests directly to the EITF, but depending on the nature of the agenda request, Rich may choose to redirect that request to the board. Similarly, agenda requests that are sent directly to the board will be reviewed by Rich, and then depending on the nature of the request, he may decide to redirect that request to the EITF. The output of the ITF's deliberation is a recommendation to the board to add a project to our technical agenda and to ratify the ITF's proposed solution in a one and done meeting. And these changes are intended to expedite the EITF's work. The newly reconstituted EITF held its first meeting in June to decide on potential amendments to how the accounting acquirer in a business combination is determined when the acquiree is a VIE. The board subsequently did agree to add that project to its technical agenda and ratified the the EITF's proposed solution. So an exposure draft on determining the acquirer in the acquisition of a VIE will be issued for public comment this fall. And I think with that, we go to our next polling question.
Indeed, we do. This is to get some more information about our audience, and this has to do with your role, your job function at your institution. So which best describes it? Tenured professor or teacher, tenured track professor or teacher, adjunct or clinical professor or teacher, department head, PhD student, other. We ask that you only answer one of those. And while we're waiting for you to answer, for those of you who may have joined a little late, I just wanted to remind you or let you know that the slides are available in PowerPoint format through a link that was provided in the chat. And it can be also found on the FASB's website, fasb.org, news and meetings, drop-down menu, educational webinars line within that. Okay. Let's wait a few more seconds and then push out the answer to this question. I think we can probably do so now, right? And again, a nice mix of attendees, some tenure track, some tenured, some adjunct, department heads, PhD students, and other. So again, welcome all of you. So with that, I'm going to do, as I've done in some past academic webinars, I'm going to take a few minutes here to update you on the activities of the Private Company Council, or PCC. The PCC was created by the FAF trustees in 2012 to enhance the standard setting process for the benefit of the private company sector. It consists of 9 to 12 members, a mix of preparers, practitioners, and users who are appointed by the FAF trustees. There are currently 11 sitting members, with the trustees also looking to fill an open preparer slot. The PCC serves as the primary advisory group to the FASB on behalf of the sector for projects on the FASB's agenda, and can also add projects to its own technical agenda or its own agenda to help improve GAAP affecting private companies, subject, of course, to endorsement by the FASB as the gatekeeper of the codification, and of course, to full public due process. This year, the PCC has a new chair, Jerry Shawver, pictured here on the slide. Jerry is the CEO of Baker Tilly US. And in his first year as PCC chair, he has led an agenda prioritization process, which we'll talk about shortly. One other thing to note, the trustees are also in the process of completing a periodic review of the PCC. That's the FAF trustees. And there's much more on that on the FAF's website. Move on to the next slide. Before highlighting the PCC's current activities, let me remind you of a very important tool that both the PCC and the FASB use. That's the Private Company Decision-Making Framework, or PCDMF. It was created by the PCC and the FASB jointly right after the PCC was formed about a decade or so ago, and it can be found on the FASB's website. It's essentially a cost-benefit overlay to the conceptual framework, and it's a key tool in helping the PCC and the board decide whether either alternatives or practical expedients may be appropriate for private companies within GAAP. Now, an accounting alternative is a different way of accounting for or disclosing something, while a practical expedient is a shortcut or simplification that gets you to substantially the same accounting answer as the regular way of accounting for something. The PCDMF focuses on relevance of the information to those who use private company financials in their resource allocation decisions, while also considering cost and complexity. And this final slide shows on the left-hand side of the slide some of the projects on the FASB's agenda on which the PCC has provided input and feedback over the past year in its primary advisory role on behalf of the private company sector. On the right-hand side are the 4 current PCC research projects that were identified in the agenda prioritization process that I mentioned a little while ago. In that process, PCC members ranked 16 agenda issues identified by PCC members, FASB members and FASB staff, and private company stakeholders with the aim of making meaningful, widespread, near-term improvements through alternatives or expedients to benefit the private company sector. 2 of these areas will be discussed and deliberated at the September PCC meeting in a few weeks, later this month. The first of those is on determining credit losses for short-term accounts receivable and contract assets. That's an issue affecting many non-financial industries. They are the generally short-term nature of the assets themselves, and the typical 120 to 150-day reporting time frame for private companies could point to expedients such as considering collections subsequent to year-end as a key aspect of developing a reasonable and supportable forecast. That's part of determining an allowance for credit losses. The second issue is that they'll be discussed later this month is on presentation of conditional retainage and overbillings as contract assets and contract liabilities. This is an issue that's especially important in the construction industry, and there are a lot of private company contractors. And an option to present or disclose such information on a gross basis rather than just net may be responsive to feedback we've heard from lenders and sureties, 2 of the key user groups of private company financial statements, particularly construction industry companies. The other 2 issues that are listed here are expected to be discussed within the next 2 or 3 scheduled PCC meetings. Those are first, a research project on debt modifications, which is an area that we continue to hear is costly and complex to navigate through and or apply. And secondly, on potential lease accounting simplifications. And with regard to the latter, a PCC group is continuing to study this area for possibilities. And with that, we have our next polling question number 3. And this has to do with, let's push that out. How do you keep up to date with the activities of the FASB? And on this one, please select all that apply. Something I just mentioned a little while ago, I'm subscribed to FASB's Action Alert or other newsletter at fasb.org/. Okay, that gives you where to go. 2, B, I follow the FASB on social media. C, I watch public board meetings. D, I keep up to date with a different method. Or E, I attend this webinar every year. Again, all that apply. Christine, I think you have a question you want to answer on the EITF.
I do. So the question that came in is, what are the consequences of EITF changes? Do these changes remove the ability for the board to propose or investigate alternative solutions to EITF recommendations? So it doesn't change the process in that the EITF always came up with a recommendation, and then it would come to the board, and the board would either ratify or not ratify by a majority vote of the board, whatever that EITF solution is. So that aspect of it isn't changing. I would say that what these changes are going to do is allow the EITF to be more nimble. One difference, I guess, from a board member's perspective is that the board members used to be at the EITF table during the discussions. And now it's just the chair and the vice chair that are actually at the table, although we see all of the materials that are being discussed. So in terms of, proposing alternative solutions, I would say that hasn't changed.
Thanks, Christine. And I have a quick answer to give on a question, which is, I talked a little while ago that there are 11 sitting members and 1 vacant slot on the PCC. Question is there an academic on the PCC? And indeed there is, and that's Bradley Hendricks, who is an associate professor at the Keenan Flagler School of the University of North Carolina. So with that, let's push out our answers to question 3. And a lot of you seem to be subscribed to Action Alert, but others follow on social media, maybe some of the same folks as well. Watch public board meetings, a hearty few that do that. Keep up to date with a different method, and glad to see that a lot of you attend this webinar every year. Awesome. So with that, I'm going to turn over to Derek Christensen, who's going to talk about our various academic initiatives.
Okay, thanks, Jeff. I appreciate you handing it off to me. So the FASB has many initiatives to engage with academia. I'm going to spend the next 5 to 10 minutes discussing 7 of the more prominent initiatives. And so the first 3 that I'm going to discuss all give academics an opportunity to connect with the board and staff in the FASB offices here at Norwalk, or in Norwalk, Connecticut, excuse me. But if you cannot travel to Norwalk, Connecticut, the last 4 provide opportunities to engage with the FASB in a variety of ways that require no travel. So with that, let me jump into the first initiative that I'm going to talk about, which is my role, the postdoctoral fellow. So every academic year, the FASB hires 1 new PhD accounting graduate to serve as the postdoctoral fellow. The purpose of the role is to help integrate academic research into the standard setting process. During the 1-year appointment, the fellow will serve on a variety of active technical and research project teams, as well as post-implementation reviews, and they may act as a consultant to other teams working on various projects that are hoping to integrate academic research. So in addition, the postdoctoral fellow will also liaise with the academic community. So if you have any questions or resources that you'd like to share with the FASB, you can reach out to me and contact me at academics@fasb.org. Or you can use the academic portal, which I will touch on at the end of my presentation here. So the role has many benefits. The PDF gets firsthand experience with the standard setting process, and they get to develop connections with preparers, auditors, regulators, users, as well as board members. In my personal experience, these connections and insights have been extremely helpful in identifying challenging standard setting topics that lend themselves to academic research. The PDFs also have access to in-house XBRL training and data, as well as subject matter experts in the field of standard setting. Finally, the PDF has time to continue their existing research projects that they started before they step into the role. So far, all 7 of the fellows have received a 1-year delay on their tenure clock, which is extremely helpful for anybody that is trying to push along research while also fulfilling the roles of the PDF. The recruiting process for the next PDF will begin later this month, and we expect a submission deadline in the middle of November. If you know any candidates that would be interested, please pass this information along. So in addition to the postdoctoral fellowship, the FASB offers a summer program for PhD students and faculty. During the program, participants get to observe a FASAC meeting. They take an in-depth dive into the FASB's conceptual framework. They engage in discussions with the managers of specific projects, and they get to socialize with FASAC members, board members, and staff. We rotate the program annually between PhD students and faculty. In 2025, we'll be hosting faculty, and in 2026, we will be hosting PhD students. I was lucky enough to attend the PhD student summer program in 2022, and I can attest it was an invaluable opportunity to connect with board members and staff. But it was also very helpful to connect with other PhD students interested in standard setting topics. We will begin sending universities invitations to nominate participants for these programs in the upcoming month of February. Finally, the Emerging Financial Reporting Issues Research Symposium provides another great opportunity for academics to connect with other academics, board members, and staff within the FASB offices. The symposium is a co-sponsored event by the FASB and the Chukasian Accounting Research Center of the University of Chicago, and it's intended to encourage and support research relevant to financial reporting issues in the early stages of standard setting. So earlier this year in April, the FASB hosted its first symposium, which focused on the topic of intangible items. Unfortunately, I wasn't able to attend those sessions myself, but from the various attendees that I've talked to, the feedback has been overwhelmingly positive. That symposium consisted of 3 paper sessions, each with an academic and standard setter discussant, and 2 panel sessions with accounting and economic experts that are well versed in the topic of intangible items. The FASB will be hosting the 2025 symposium on April 5th at our offices. The topic of the 2025 symposium is the statement of cash flows, which is currently on the FASB's research agenda. And there's also a small targeted improvements project on the technical agenda. That symposium will consist of 2 paper sessions as well as 2 panel sessions. The first panel session will have a group of investors giving their takes on how the statement of cash flows is useful in their decision making. And I cannot emphasize enough, this is a panel that you won't get anywhere else. As I'm sure you academics know, investors can be tricky to pin down. And then the second panel session will give the view of standard setting from the standard setter's seat related to the statement of cash flows. And that's going to include board members from the FASB, the IASB, and various accounting standards boards around the globe. If you're interested in contributing to the 2025 symposium, I highly recommend reviewing the slides from our March 1st webinar, requesting research on the statement of cash flows. And also the second link on this slide will take you to the submission page if you do have any statement of cash flows research that is relevant to the Financial Accounting Standards Board. The deadline to submit your research for consideration in the 2025 symposium is November 15th, 2024, and registration will open later in December. So beyond the initiatives that take place in Norwalk, there are many other opportunities to engage with the FASB. The FASB Emerging Scholar Award recognizes a 3rd or 4th year PhD student with a proposed doctoral thesis judged to be the highest quality in terms of its potential contribution to academic standard setting. In addition to being recognized, the winner also receives $2,500 from the FASB and provides an initial opportunity for the student to discuss the research with FASB staff. I was lucky enough to win this award in 2022 and cannot overstate how helpful it was to get me connected with the FASB members and staff and get feedback on my dissertation as I progressed through the analysis stages. The nomination information is available on our webpage, and we will be accepting applications starting early in February. And on that note, I would like to recognize the most recent Emerging Scholars Award recipient, Will Anding from Florida State. Will's dissertation examines the implementation process preparers and auditors use when adopting new accounting standards and sheds light on some of the costs of adopting accounting standards. And Will is currently on the job market, so keep an eye out for Will if you are hiring at your institution. The FASB also has resources for PhD students and faculty interested in leveraging the power of XBRL for their own research. In my experience, XBRL provides 1, more timely financial statement information than traditional data providers like Compustat or FactSet. And second, it also tracks additional data points that are not currently provided by data sets like Compustat or FactSet. For example, an entity's incremental borrowing rate disclosure that's required under the new lease standard is tracked via XBRL, but I'm not aware of any data point in Compustat or FactSet for that discount rate. If you're interested in learning more about XBRL, there are several videos on the FASB's website. To learn more about the potential uses of XBRL for academics, you can follow the link on this slide. And finally, the last initiative I'm going to talk about is the FASB's Postgraduate Technical Assistant Program. This program targets students in a master's degree or double major. For example, students completing their master's in accounting or students completing a double major in accounting and finance would be eligible. PTAs work on projects on the technical or research agenda, as well as short-term practice and implementation issues. They're involved in all phases of the standard setting process and participate in public board meetings and task force meetings. I cannot overstate the skills and networks that PTAs develop from this program. During their time, PTAs will get to interact with business leaders from a variety of fields, including audit, finance, and more. The program is highly selective. Someone within the accounting department must nominate students to apply for a PTA position. We're going to kick off the process of recruiting PTAs later this month by emailing schools an information packet. If you think your school is not on this email list but would like to be added, please email humanresources@faf.org. We have positions available for both winter and spring start dates, depending on the student's graduation timeline. And so with that, before I turn it over to our next polling question, I just want to highlight the academic landing page on the FASB's website. For anybody that's interested in participating in any of the initiatives I've talked about, you can visit the FASB's academic landing page, and there will be information about those initiatives. But on the landing page, there also is information about other initiatives that I didn't get a chance to talk about today. The one that I am going to mention just very briefly is the FASB's academic research portal. If you have any research that you believe is relevant to the FASB or one of its projects, please submit that research to our portal. We welcome all submissions, whether they be working papers or published. And if you have any questions about that initiative or any of the other initiatives, you can contact me at academics@fasb.org.
All right, so we have another polling question, and this has to do with your potential interest in some of the academic initiatives that Derek just mentioned. It asks, which of those are you most interested in? Now, since it says select all that apply, I'd just say ignore the word most and just tell us about any that you're interested in, check off any that you're interested in, and I won't read these all to you, you can see them. But I do have, Christine, I know, wants to answer a question that has come in about academics.
Yes. So the question that came in was, I'm under the impression that FASB was required to have an academic on the board. Has that changed? So no, it hasn't changed. It's just that there's never been a requirement for any specific type of board member, whether it be an academic, an auditor, a preparer, an investor. There isn't written into the bylaws of the foundation a specific number of seats, that certain types of board members with certain types of experience have to fill. And in fact, that's changed over time. There's more investor type board members today than there were back when the board was younger in its life. So really the only requirement for board members is that the board collectively has to have knowledge of and experience in investing, accounting, finance, business, accounting, education, and research. And so it's up to the trustees as they go through their process and think about what the needs of the board are to determine, based on their judgment, how best to fulfill those characteristics and that experience that the board is supposed to have collectively. So hopefully that helps to explain things a little bit better.
And I think, Derek, you have a question that's come in about our postgraduate technical assistant program.
Yeah, thanks for the question, Paige. So yes, the position is paid. It's the pay and benefits are competitive with other jobs that students might get in Big Four accounting after they leave their undergraduate or master's program. And the role lasts for a year. But because we have a winter and summer start date, the PTAs will be staggered with the other groups that come in. So each 6 months, there's a new group of PTAs coming into the program. And so those that start will have PTAs that have been there for 6 months to kind of show them the ropes and get them oriented to the organization.
Okay, terrific. Let's push out our answers here to this question. It looks like many of you are interested in lots of these programs. So there's all sorts of good information on the slides that Derek just went over. And we encourage you to contact us about them. Okay, with that, I'm going to turn it over to Nellie Debler, who's going to take us through an overview of the FASB's technical and research agenda.
Great. Thank you, Jeff. It's wonderful to be here with you all today. So if we go to the next slide, we've got an overview here of our technical agenda at the FASB. And I will actually first direct your attention to the note on the side of the slide. The board regularly adds or completes or removes projects from its agenda, and in between our kind of annual updates on this webcast, since many of you join us for this frequently, you can always find the full technical agenda on our website. It's regularly updated there. You can get links to other details about each project and so on. We are discussing a lot of the projects on this slide in other parts of our webcast today, so I won't go into too much detail about those. However, I will highlight we've got color-coded projects on this slide. So we mean something by this. Let me explain what we meant there. The projects in red have been voted on by the board to issue a final standard, which we expect by the end of 2024. And the projects in blue have been voted on by the board to issue an exposure document for public comment by the end of 2024. That is the majority, as you can see. That's 8 exposure documents and 2 final. One of the exposure documents is already out, as you can see noted here, and the others are hot on its heels. So given that level of activity, it does sort of beg the question of what the FASB will do next. That, as it happens, is a question on which we would like your input and input from the rest of our stakeholders as well. Rich, the FASB chair, announced earlier this year that we'll undertake an agenda consultation process towards the end of 2024, similar to what we had done in 2021. We think it's just very important to ask stakeholders what they want us to work on next, how priorities may have shifted in recent years, and they can gauge based on the project we've been able to make on these topics and other things that we've recently completed, some of which we'll talk about, on what those priorities might be. So we'd love to hear from you all as part of that process through the comment letters or otherwise. And if we go to the next slide, we cover our research agenda. There's a lot of interesting projects on our research agenda right now. And actually, many of these were right at the top of the list for what you all indicated you were interested in hearing about in our registration survey. So I'll say a little bit about some of these research agenda projects. First, let me sort of set the scene. The research agenda is controlled by Rich, the FASB chair, generally used for topics where we need to gather some more information to help the board decide what to do in a particular area. Adding a project to the technical agenda, go through the board's well-established agenda decision process, which we've got agenda decision criteria, and that is a majority vote of the board. So I already described the agenda consultation on the bottom left here. The next one I will mention is financial key performance indicators. This was the clear winner in terms of interest, I think, in terms of people, what they're curious to hear about. So the question at issue in the KPI project here is pretty straightforward. We know financial KPIs like EBITDA, as an example, are frequently used by management. They're reported outside of the financial statements. However, different entities calculate and adjust those metrics differently. We know that this is an area of a lot of academic research over the years, and a lot of interest from our stakeholders broadly. So what the board is thinking about understanding here is whether standardizing the definition of some key KPIs like EBITDA would be useful to investors, and whether that should be required to be disclosed in the financial statements, kind of bringing that into the footnotes, for example. So while that question's pretty straightforward, the feedback and the opinions on this issue are not as straightforward. So there's a lot of diversity of opinion, and that's why Rich decided that we're going to go towards an invitation to comment, which we also expect to be issued before the end of the year, just to better understand perspectives there. The other one I wanted to mention briefly is our intangibles research project, partially because this is the other research project area where we expect to issue an invitation to comment. The invitations to comment are documents issued by the staff. They don't have like board views or like proposals in them, but they're just a way to solicit feedback and ask questions of our stakeholders in kind of an open, formal, rigorous way. Intangibles is another topic where there's been considerable interest over the years. And many of the topics that the board has worked on in recent years are technically related to intangible items. Crypto, environmental credits, software, those are all technically intangibles. That's part of what's interesting about intangibles. There's a lot of discussion about them as a collective, but actually within the topic of intangibles, there's a lot of different types, and maybe those have different characteristics and need to be treated differently. So we're looking forward to understanding stakeholder perspectives on this issue as well, and in particular, what the board should consider focusing on, and maybe what approach they should take. I think it's time for another polling question, and I will turn it over to Jeff.
Okay, thanks, Nellie. Polling question number 5. Which research projects are you interested in? Ignore the most, select all that apply. And you can see what they are, all the ones that were listed on the slide that Nellie just went over. So we'll wait for you. I don't know if there's any other questions to answer at this time. If not, we'll wait a minute, a few seconds or whatever for you guys to finish answering this question. And then I'll turn it right back to Nellie to talk about post-implementation review.
Absolutely.
All right, so let's push out let's push out the answers to this, and then I'll turn to Nellie. Okay, lots of interests about on a number of these, and it's interesting to see that 2 of those pertain to upcoming invitations to comment, financial KPIs and intangibles, and 1 it pertains to our upcoming research symposiums. That's great. Okay, go ahead, Nellie.
Off mute. Sorry, Jeff. I jumped ahead of myself. So we want to briefly talk about our post-implementation review process. Once a standard has been issued, that doesn't mean our work at the FASB stops. We do some level of kind of post-issuance evaluation for all of our newly issued guidance to kind of assess how they're working, what, if any, changes need to be made. But for certain standards, we have a formal post-implementation review process, which is overseen by the FAF trustees and kind of subject to their oversight. So this slide outlines the stages for the formal PIR process. And you can see that, again, that starts as soon as the standard is issued and continues for a number of years after that. Depending on the adoption dates of the various standards, this timing always kind of works out to be a bit of within a range. We like to think about the PIR process as like a quality control phase of the standard setting process. When a final standard has just been issued, we're really focused on stakeholder outreach, understand whether the standard is working, consistent with our expectations, supporting a high quality adoption. And then that helps us determine in the later stages of the process whether the information that standard is providing to the market is worth the resources needed to deliver that. If we go to the next slide, we kind of outline our main objectives for the PIR process. Pretty straightforward. Essentially, did we do what we set out to do in the guidance or with this project? Is the value of that information really worth what's required to deliver it? And could we, the FASB, be better in the process of doing so? We say often around here that we're interested in continuous improvement and obtaining feedback in order to learn about ways we could improve, and that's embedded in this PIR process as well. So we've got 3 PIR projects currently active. We had 3 major standards issued over the last decade or so. So those are the ones that have made it into the formal PIR process. You can see that these are hyperlinks. So they link to pages on our website with a bunch more information about these specific PIR efforts, what we've done on them lately. As you might expect, because it was the first one issued of these 3, revenue is the furthest along. And actually for revenue, we expect to issue our final report on that project later this year. And we need to keep moving along, but I will also highlight that a piece of our PIR process is looking to academic research into these various topics and what that can tell us about how well the standard is working or other aspects of our PIR objectives. So I think that's it for me.
Great.
And we're going to have, then I'm going to turn it over to Jill Sweater, who's going to talk about conceptual framework.
Great. Thanks, Jeff. The board has actively been working to improve and complete their conceptual framework over the last few years. The measurement chapter was issued in July of 2024, and it marks the completion of the board's conceptual framework. The FASB's conceptual framework is now housed entirely in Concept Statement 8 and is organized into chapters, which is shown on this slide. I'm going to spend a little bit of time talking about our new measurement concepts. The purpose of the measurement chapter is to help the board make more consistent and well-supported standard-setting decisions about the measurement of assets and liabilities. The board agreed to base the measurement principles on a couple of fundamental concepts. First is that measurements are anchored in prices. Second, that the reported amounts of assets should not be more than what is recoverable, and the reported amount of a liability should not be less than the settlement amount.
And third, that measuring all assets and liabilities using one measurement approach, for example, fair value, would not best achieve the objective of financial reporting. Instead, depending on the nature of the asset or liability, or how an asset is used or a liability is settled, entry prices or exit prices could provide the most relevant information. As a result, the most important measurement principles are those that help the board determine when an entry price or an exit price is the most relevant basis for measurement. An important factor in making this choice is whether the price the entity expects to realize is unique or non-unique to the entity. For example, gold held for use in making jewelry is more likely to result in the entity realizing a unique price for its gold, whereas gold held for sale as a trading asset is more likely to result in the entity realizing a non-unique price for its gold. When a non-unique price is realized for an asset, the entry price system, which is essentially the historical cost method with amortization and impairment, is preferred because that measurement basis provides information that investors find useful in forecasting cash flows. When a non-unique price is realized for an asset or used to settle a liability, the exit price system estimated with market participant cash flows, which is essentially fair value, provides more relevant information. I think next we're on to a polling question, Jeff.
Sorry about the delay there. Okay, so we're up to polling question 6. This is about the conceptual framework. How do you use the conceptual framework for academic purposes in my classroom in considering research projects, research topics, both or neither? So I think, Nellie, you have a question or two to answer?
Yes, we got a couple of questions in the chat. The first one is about the PIR projects and kind of illustrations or other supporting information there. There's a lot of information about the PIR projects and the standards underlying them that is on the FASB's website. As I noted in the original guidance, there'd be examples of like how the guidance works. And I think there's also information available for some of the PIR projects where there's research, where there's a PIR ongoing. We've asked for research and also talked a little bit about what types of research might be available as well. So that might be something else to look for. And the other question that we got in the break was about generally about concern about standards overload and to what extent the FASB's projects add to additional requirements rather than reduce them. I think that's definitely something that the board has heard over the years. And I think that's something that the board members take into consideration, in particular when making their judgments on individual standards. If in respect of the activity that the board is currently kind of undertaking, I think the board has done a really good job of making sure that the projects that they're working on are targeted and well-defined and kind of achievable in that sense, and that there's a clear case for change for why the guidance is an improvement and what that relates to. So hopefully that helps kind of assess some of that concern, but that's really a matter of judgment that kind of is embedded in the board's decision-making process. Maybe time for the answers for this.
Yeah, let's do that. And so you can see the answers: 41% in classroom, 12% in research projects, 26% both, 22% neither. Okay, so with that, we are going to go to Christine, who's going to talk about some of our technical agenda projects.
Great, thanks, Jeff. Appreciate that. So yes, we're going to move on to some of our technical agenda projects now, beginning with our project on environmental credit programs. So we took on this project in response to feedback on our 2021 invitation to comment on the agenda, where some stakeholders expressed concern about the lack of guidance on how to account for certain environmental transactions, such as renewable energy credits, emission allowances, carbon offsets, and cap and trade programs. Entities often obtain environmental credits for a variety of different reasons, including for use in settling regulatory compliance obligations, for trading purposes, or for voluntary purposes, such as meeting self-imposed pollution reduction targets. Through outreach, the staff learned that the accounting for environmental credits often is based on how the credit is going to be used by the entity, and that there is significant diversity in how entities account for their environmental credits. For example, compliance participants that acquire or are granted credits from regulators as part of emission control programs often measure their credits at historical cost with no impairment or amortization. Trading participants that buy and sell credits to generate income often measure their credits using historical cost with impairment or at a lower of cost or market. And finally, voluntary participants that acquire credits to claim reductions against their actual emissions, either for ESG reporting purposes or to meet their internal reduction targets, account for their credits by expensing them immediately upon acquisition or recognizing them as assets measured at historical cost less impairment, or recognizing the credits as assets and measuring them at historical cost with no impairment. So to address this diversity in practice, we added this project in May of 2022 to improve the recognition, measurement, presentation, and disclosure of compliance and voluntary environmental credit programs. Now, to be within scope of the project, the board decided that an environmental credit must represent an enforceable right that is acquired, internally generated, or granted by a regulatory agency that has the following characteristics. So first, it lacks physical substance and is not a financial asset. Second, it's represented to control emissions or other pollution. Thirdly, it is separately transferable in an exchange transaction. And finally, it is not a tax credit, such as a refundable or transferable clean energy tax credit. We also, in this project, define what is an environmental credit obligation. And that is an obligation that may be settled with environmental credits, which arise from laws or statutes represented to control emissions or other pollution. But we did specifically say that obligations that are within the scope of subtopic 41030 asset retirement and environmental obligations are scoped out of this proposed guidance, regardless of whether that ARO can be settled using environmental credits. The types of items that would be affected by this project, next slide, include carbon offsets, carbon credits, renewable energy credits, renewable identification numbers, cap and trade emissions programs, baseline program allowances, CAFE credits, environmental credits received from partnerships or other equity structures that generate credits. And the types of items that would not be within scope of this project include transferable or refundable clean energy tax credits, additional payments that are made for carbon neutral activities where no credit is issued or transferred, investments in partnerships or other equity structures that generate credits, or other sustainability reporting more generally. The diagram on this slide summarizes the board's decisions regarding asset recognition and measurement. If it is not probable that a credit will be used to satisfy an environmental credit obligation or be sold, it is expensed upon acquisition. And we refer to these credits as voluntary credits. If, on the other hand, the answer to the first question is yes, the credit will be used to satisfy an environmental credit obligation or is being held for sale, then the next question is whether it's probable that the credit will be used to satisfy environmental credit obligation or not. And if the answer to that question is no, meaning that the credit is essentially being held for sale, the credit would be recognized as an asset at historical cost subject to impairment. And we refer to those credits as non-compliance credits. Now, in addition, we did decide that a fair value option would be allowed to account for some of those non-compliance credits, mostly those that are acquired in an exchange transaction. And so if an entity believes that fair value measurement would provide more decision useful information, they have that option. Finally, if the answer to that second question was yes, that it is probable that the environmental credit will be used to satisfy an environmental credit obligation, we refer to those credits as compliance credits. And in that case, the credit would be recognized as an asset measured at historical cost without impairment. The environmental credits obtained through a grant from a regulator or internally generated are going to have minimal historical cost, because historical cost will be limited just to the transaction costs that are incurred, which could be zero if none are incurred. And if the environmental credit is obtained otherwise, then historical cost is measured consistent with subtopic 80550 to include both the cost to acquire the credit and any transaction costs that were incurred in that acquisition. The board also decided that an environmental credit that is transferred in a contract with a customer must be derecognized in accordance with topic 606 revenue, and an environmental credit that is transferred in a contract with a non-customer must be derecognized in accordance with the guidance pertaining to gains and losses from the derecognition of a non-financial asset. In addition, the board decided that at each reporting period, entities would have to reassess the probable use of an environmental credit. And if an environmental credit was expensed because it was deemed to be a voluntary credit, the entity would be prohibited from subsequently recognizing that credit as an asset. And if an environmental credit that was probable of being used to satisfy an environmental credit obligation or of being sold is no longer probable of being used for either of those purposes, then that environmental credit must be derecognized at that time through earnings. Finally, if an entity were to reclassify an environmental credit from compliance to non-compliance or vice versa, they are required to test the credit for impairment before applying the appropriate subsequent measurement guidance. Now, this diagram summarizes the board's decisions regarding the liability recognition and measurement for environmental credit obligations. The board decided that a liability must be recognized when events such as emissions occur on or before the balance sheet date, which indicate that an environmental credit obligation exists. Because compliance periods often do not align with an entity's year end, the board also decided that when determining whether to recognize an ECO liability, the balance sheet date would be treated as if it were the end of the compliance period. The measurement of the liability depends on whether the entity has sufficient environmental compliance, environmental credits on hand to satisfy its environmental credit obligation liability. The portion of the obligation that is funded by compliance credits on hand is measured based on the carrying amount of those credits. The portion of the obligation that is unfunded is measured at fair value of the credits that would be needed to settle that portion of the liability, unless the entity intends to settle with cash, in which case the unfunded portion would be measured at the cash settlement amount that is prescribed in the program, or if the entity intends to settle using credits that are obtained through existing commitments to purchase a fixed quantity of credits at a fixed price, then that portion of the unfunded portion of the liability would be measured at the cost basis of those credits. An entity must apply these measurement requirements at each balance sheet date and recognize any changes in the liability in earnings. And finally, the liability is derecognized in accordance with subtopic 40520 pertaining to the extinguishment of liabilities, with any gains or losses upon derecognition recognized in earnings. And we expect that derecognition would generally occur when the credits are remitted to the regulator to satisfy the liability. Now, the board decided to require gross presentation of the environmental credits on the asset side and the environmental credit obligations on the liability side. The board decided not to provide any additional implementation guidance for the cash flow statement because we felt that the guidance in topic 230 was sufficient. We also decided to be clear that an entity is prohibited from capitalizing the cost of a voluntary credit, even as part of the cost of another asset, such as inventory or PP&E, and that non-refundable deposits for voluntary credits also have to be expensed as incurred. We decided that an entity should recognize acquired environmental credits and environmental credit obligations that are assumed in a business combination in accordance with topic 805, and that those acquired environmental credits would be measured in accordance with topic 805, and the assumed environmental credit obligation liabilities would be measured in accordance with the requirements developed in the environmental credit project. We also settled on a very robust set of proposed disclosures, including information about an entity's involvement in environmental credit programs and the types of credits that they own, disclosure at annual and interim periods of significant environmental credit holdings, including the description, the carrying amount, and the classification of the credits, and significant environmental credit obligation liabilities, including a description of the compliance program and the carrying amount of the liability disaggregated between the funded and unfunded portions. The board also decided to require certain revenue and expense information, including revenues from sales of environmental credits and contracts with customers, and the carrying amount of those credits at the date of sale, gains and losses from the sale of environmental credits with non-customers, and the carrying amount of those credits, the date of sale, total revenues or gains from sales of voluntary environmental credits that were never recognized as assets or were previously de-recognized because it was no longer probable that the credits would be sold or used to settle an ECO liability. Also, total expenses recognized for environmental credit obligations, disaggregated by accruals for emissions during the reporting period, and remeasurement of the liabilities that were previously recognized. The disclosure of total expense recognized for environmental credits not initially recognized or subsequently de-recognized because it was no longer probable that those credits would be sold or used to satisfy a liability is also required. And total impairment expense, the nature of the impaired environmental credits, and a description of the circumstances that gave rise to the impairment is also required. In addition, entities would be required to disclose the cash paid for environmental credits that were acquired during the period. And we affirmed that the disclosures in topic 820 fair value measurement would be required for any of the measurements that are at fair value. Finally, we decided that these requirements would apply to all entities, including private entities. So in terms of transition, we decided that entities would be required to adopt the proposed guidance using a modified retrospective approach. Under that approach, entities would apply the guidance as if it had always been applied, with an adjustment to the opening balance of retained earnings as of the beginning of the annual reporting period for which the guidance becomes effective, subject to certain additional requirements that are intended to ease the transition. So first, that the asset recognition requirements would be applied based on the planned use of the credit as of date of initial application of the guidance. Second, that at the date of initial application of the guidance, a compliance credit would be measured using its carrying amount immediately prior to the date of initial application. A non-compliance credit would be measured at the lower of its carrying amount immediately prior to the date of its initial application and its fair value at that time. And non-compliance credits for which an entity elects fair value would be remeasured using the fair value of the credit at the date of initial application. In addition, entities would continue to include the cost of the credits that have been capitalized as part of another asset, such as inventory or PP&E, before the date of initial application of the guidance within the carrying amount of that asset. And finally, the amendments to topic 805 business combinations would be applied prospectively to transactions occurring after the date of initial application of the guidance. So the staff is in the process of drafting an exposure draft for public comment. The exposure draft should be issued sometime this fall. And if this is a topic of interest, do please share your opinions with us by submitting a comment letter. The next project that I'm going to update you on is the accounting for and disclosure of software costs, which was added to our agenda in June 2022. And we added this project in response to the 2021 agenda consultation when we heard concerns primarily from preparers and auditors that the guidance is costly to apply and that it's outdated because how entities go about developing software has evolved from the waterfall method that used to be conducted in stages to a method referred to as the agile method, which is more incremental and iterative in nature. Now, while this was not a priority project for many investors, most indicated that they would like more transparency around entity software cost expenditures. I'm sure that you're familiar, as you probably taught this to your students in the past, that there are two models to account for software costs, and that these models have remained basically unchanged since they were developed in the 1980s and 90s. Subtopic 35040 applies to internal use software, meaning software that the company is developing or has purchased for its internal purposes, like a CRM system implementation. Conceptually, the model in subtopic 35040 is a PP&E type model with costs incurred during the building or application development phase, generally being capitalized. We also have the subtopic 98520 model, which applies to external use software, meaning software that a company plans to market externally through direct sale or licensing. The model in subtopic 98520 is more of an R&D type model with costs incurred prior to establishing technological feasibility being expensed and costs incurred after that point, but before the software is available for general release being capitalized. Many companies that apply this guidance end up expensing most, if not all, of their software development costs as incurred, similar to the accounting that they would arrive at if they were applying the R&D accounting. So making things a little more complicated, application of the internal use 35040 model is not limited to software that is used solely for an entity's internal use. It is also applied for the development of software that is marketed for sale as a cloud access product, because that software is not technically transferred to the customer. 35040 is also applied to the costs incurred by the customer to implement that cloud computing arrangement. The objectives of the software project are to modernize the accounting for software cost expenditures and to enhance the transparency of expenditures for software cost development. While both subtopic 35040 and subtopic 98520 were initially within the scope of this project, along the way, we decided not to make any changes to the recognition and measurement of software accounted for under subtopic 98520 and make only targeted improvements to the guidance in subtopic 35040. So the proposed amendments would remove all references to project stages throughout subtopic 35040, and instead entities would begin capitalizing software costs when management has authorized and committed to funding the software project, and it is probable that the project will be completed and the software will be used for the purpose intended. We refer to this as the probable to complete recognition threshold. Now, if a project does not clearly meet that threshold, then the entity should go on to consider if there are significant uncertainties associated with the development activities, including whether the software is novel or unique or has unproven features, and whether the entity is still substantially revising the performance requirements. Entities would be required to separately present cash paid for capitalized internal use software costs as investing cash outflows in the statement of cash flows, which may not capture the full amount capitalized during the period due to non-cash transactions such as stock-based compensation. The board also decided not to change the existing disclosures for software expenditures and to supersede the website development cost guidance in subtopic 35050 by incorporating that guidance into subtopic 35040. The proposed amendments would be applied on a prospective basis as of the initial application date with a retrospective adoption permitted. Again, the staff is currently in the process of drafting an exposure draft, which should be issued later this fall with a 90-day comment period. And again, I would encourage you to share your opinions with us on this guidance through the submission of a comment letter. So the next project on today's agenda is the Accounting for Government Grants project. And accounting for government grants received by business entities is one of the few areas in US GAAP for which there is no specific guidance. And as a result, there is diversity in practice. Some business entities analogize to IAS-20 grant model, while others analogize to subtopic 958-605, which is the US GAAP model that not-for-profit entities use to account for grants received and that business entities use to account for grants received from non-government entities such as the Gates Foundation. Rich added a project to his research agenda in December 2021 and directed the staff to issue an ITC to solicit feedback on whether IAS 20 should be subsumed into US GAAP. In November 2023, the board voted to add a project on the accounting for government grants by business entities to its technical agenda. And this slide and the next outlines the board's proposal. So the board decided to subsume IAS 20 into US GAAP with only minor amendments. The scope of the guidance includes transfers of monetary and tangible non-monetary assets from a government to a business entity, including forgivable loans when the recognition criteria are met. The scope excludes exchange transactions, including transactions with the government that are within the scope of Topic 606 or within the scope of Subtopic 61020. The scope also excludes transactions within the scope of Topic 740 income taxes, below market interest rate loans, and government guarantees. Under the proposal, a government grant would be recognized when it is probable that the entity will comply with the conditions of the grant and that the grant will be received. Use of that probable word instead of a reasonable assurance, which is what is in IAS 20, is one of the few changes that has been made from the IAS 20 guidance. A tangible non-monetary asset received as a grant from a government will initially be measured at fair value, but next slide. The recognition of the grant income depends on whether the grant is an asset grant or an income grant, because IAS 20 includes different accounting models for grants related to assets and grants related to income. An asset grant includes a monetary grant for the acquisition or construction of an asset or the grant of the non-monetary asset itself. For those grants, entities have the choice to recognize the grant income as a deferred liability, which is referred to as the gross-up approach, or to deduct the grant income from the fair value of the asset, which is referred to as the cost accumulation approach. In any event, grant income is effectively recognized in income over the life of the asset if the asset is depreciable, either as a deduction from depreciation expense or as a separate line on the income statement or in other income. Now, if the asset is non-depreciable, the grant income may be recognized in income over the periods that bear the cost of meeting the obligation or upon sale of the asset. Government grants related to income are recognized in income in periods in which the entity expenses the related costs for which the grant is intended to compensate. And entities can choose to recognize the grant income as a separate line on the income statement or as part of other income or netted against the related expense. Entities that have government grants within the scope of this project must provide the disclosures in Topic 832, Government Assistance, but asset grants accounted for under the cost accumulation approach are exempted from certain of those disclosures. And the staff is currently in the process of drafting an exposure draft for public comment, so that'll be coming out soon. But 3 of us are dissenting, myself and our 2 investor board members, Joyce Joseph and Fred Cannon. So the next several slides are going to outline what you will see in my dissent, and along the way, I will highlight what Joyce and Fred are dissenting over because the basis for their dissent is narrower than mine. So in my opinion, IAS 20 is a low quality standard. It was created over 40 years ago by the organization that preceded the IASB, and it was not created to improve financial reporting, but it was created by the IASC to just codify the existing global diversity in the accounting for government grants. It's based on an out-of-date notion of matching, which results in financial reporting outcomes that violate FASB's conceptual framework. Specifically, the cost accumulation approach for accounting for grants violates the asset definition and the recognition principle because it can result in assets not being recognized despite the existence of an item that meets the recognition criteria of meeting the definition of an asset, being measurable using a relevant measurement basis, which investors have said is fair value, and the ability to depict that fair value and that asset with faithful representation. In addition, the gross-up approach for accounting for asset grants violates the recognition principle and the liability definition because it results in liabilities being recognized for which there is no present obligation to transfer an economic benefit once the conditions of the grant have been met. Now, instead of subsuming IAS 20 into US GAAP with minor modifications, I would have preferred that we address the lack of GAAP for government grants received by business entities by extending to those grants the subtopic 958-605 model that those entities already applied to grants from non-government entities such as the Gates Foundation. Under subtopic 958-605, grants are recognized in income when the conditions of the grants have been substantially met or have been explicitly waived. This approach, which is conceptually a performance obligation approach, is more aligned with income recognition under topic 606 revenue and under subtopic 61020 gains and losses from derecognition of non-financial assets. In addition, subtopic 958-605 does not result in the recognition of liabilities that violate the board's liability definition, nor does it result in the non-recognition of assets that meet the asset definition, both in violation of the board's recognition principles. In addition, it would ensure that business entities account for grants the same way, regardless of whether they are received from a government or a non-government entity, and it would be responsive to investor feedback on their preferred accounting for grants received by business entities. So this slide summarizes the investors' feedback, the outcomes that are produced by the board's IAS 20 approach, and the outcomes that would be produced by the subtopic 958-605 approach. So investors requested gross presentation on the balance sheet and the income statement. The board's IAS 20 approach allows for net presentation on both statements, whereas subtopic 958-605 requires gross presentation. Investors also requested that granted assets be recognized and measured at fair value. Under the board's cost accumulation approach, a granted asset is measured at fair value less grant income, which may result in the granted asset not being recognized at all or recognized at only a nominal amount. In contrast, subtopic 958-605 requires that granted assets be recognized and measured at fair value. Investors requested that optionality be reduced and comparability be increased. The proposed amendments codify almost all existing optionality and do nothing to enhance comparability. Subtopic 958-605 would eliminate all optionality and enhance comparability. Investors requested that all grants be accounted for similarly. Under the board's proposed IAS 20 approach, financial reporting will vary by type of grantor, so whether the grant is coming from a government or a non-government entity, by type of grantee, so whether the grant is received by a business or a not-for-profit entity, and by type of grant, whether it's an asset grant or an income grant. Whereas under subtopic 958-605, all grants received by business entities would be accounted for similarly, and the accounting for grants would be agnostic to the type of grantor, the type of grantee, and the type of grant. Investors requested that all grants to business entities be accounted for using the same model. The proposed amendments provide for at least 5 different models. Subtopic 958-605 has only one performance obligation-based model. Investors requested sufficient information in the period of the grants and on an ongoing basis to address the non-comparability that would persist under the proposed amendments and to understand the effects of government grants on expected cash flow. The board decided not to require disclosure of the asset's grant date fair value on an ongoing basis, and the board decided to exempt asset grants accounted for under the cost accumulation approach from certain ongoing disclosures that would help investors address these non-comparability issues. And that item is in blue because that's the item under which Joyce and Fred have also decided to provide an alternative view. So with that, I'm through my section and I think it's on to Derek.
Thanks, Christine. So I am going to cover the last topic on the technical agenda today, which is a targeted improvements project on the statement of cash flows, which appears to be a fan favorite based on the polling questions. So just a little background about the project. In June of 2021, the board issued an invitation to comment, and in that invitation to comment, investors consistently raised concerns that the financial statements were not disaggregated to an appropriate level. And that concern was extended to the statement of cash flows. So in response to that feedback, the FASB added a project to their research agenda on the statement of cash flows, and for the subsequent year, conducted research to better understand stakeholders, particularly investors' concerns with the statement of cash flow. And that outreach culminated in the addition of a targeted improvements project to the technical agenda. However, the board did decide to keep the original research project on the research agenda to explore some of the broader issues that investors raised unrelated to these targeted improvements. And so with the targeted improvements project, the board is considering two specific potential improvements. First, the board is considering adding a cash interest received disclosure, and that would be general to all entities that prepare the statement of cash flows. It would look very similar to the current cash interest paid disclosure, which shows up at the bottom of the statement of cash flows. But in addition to that broad disclosure, the board is also considering updating the statement of cash flows for financial institutions. There's been quite a bit of feedback going on for a very long time that the statement of cash flows does not provide useful information for financial institutions. And so right now the board is exploring ways to make that information more useful, including reorganizing the statement of cash flows for financial institutions to move items from the investing and financing section up to the operating section. Because for financial institutions, the investing section contains activities that seem more operational in nature, like selling and buying securities. And in addition to that reorganization, the board is considering adding additional subtotals that provide information about adjustments related to net interest income, which for many banks is a primary performance measure. So with that, I'm going to turn it over to Jeff, and he will take us to our next polling question.
Thanks, Derek. Here's our next polling question. I believe you're only supposed to choose, single choice on this one. So which of the current technical agenda projects that were just discussed are you interested in conducting research on or teaching to your students? And you can see what they were. We just went over those projects. So please choose one or none of the above. Nellie, I think you may have one leftover question.
Not leftover, but we do have a question.
Okay.
I will say we're happy to answer any questions about anything we've talked about so far, the projects that Christine went through, any of the other stuff. So feel free to send those through. We got a question about AI and the standard setting process and kind of whether we've introduced AI tools into that process for comment letters, PIR, et cetera. That's a great question. And like many or maybe most organizations, we are thinking about kind of what this might look like or how this could help our process. I will say some of the information we work with is not public. Like we do outreach that's like interviews and kind of conversations with entities that we wouldn't want the specifics of those conversations to always be in the public domain. But with comment letters in particular, they're already public. So that's a great test case for kind of what AI might look like with that. And we actually it was pretty limited. We only a couple of staff were involved, but reviewing the comment letters on a public document is a key part of our work. And we did a small pilot on what the staff review looked like compared to what kind of an AI assisted review would look like. I will say we had some challenges. I'm sure if you all are experimenting with AI, you're familiar with some of those types of things, but I think par for the course in terms of what people report about using AI for that type of research. So yeah, there's a lot to think about there. That's obviously a place that'll continue to evolve. We're looking forward to feedback from our stakeholders on what they do with public FASB information or what they think we should think about. Jeff?
All right, thanks, Nellie. Let's push out our responses. And most of you are interested in the statement of cash flows for financial institutions, probably our other cash flow related work as well. Let me turn it back to Derek, who's going to continue talking about some other actually completed projects and issued standards.
Yeah, thanks, Jeff. So I'm going to touch on the first two, and then I'll turn it over to some of the other people on the call to take you through segments and then the accounting for crypto assets. So first, the disaggregation project related to income statement expenses. So the board recently completed its redeliberation and expects to issue an ASU in the last quarter of this year. So the project arose from widespread complaints from investors that the current income statement presentation was not conducive to forecasting future cash flows. And that concern primarily arose because items were being disaggregated at too much of an aggregated level. Specifically on companies' income statements, oftentimes line items would aggregate different natural expenses. And when I say natural expenses, I mean things like depreciation, employee compensation, etc. And that was particularly problematic when they were trying to forecast future cash flows because those different natural expenses respond to changes in economic conditions differently, which makes it hard to take investors' expectations of future economic conditions and map those into future cash flows for an entity. So in response to that, the board decided to add that project to its agenda. And that project resulted in 3 key provisions. So the first was a requirement to disaggregate relevant expense captions by these natural expense categories. And the board identified 5 natural expense categories. Those are purchases of inventory, employee compensation, depreciation, intangibles amortization, and depreciation, depletion, and amortization for oil and gas activities. And to make those disaggregation decisions, entities are required to break out any expense captions that contain one or more of those categories. In addition to that disaggregation requirement, the board also added a disclosure requirement to provide a qualitative description of items that fall in any of these relevant expense captions that don't fall into any of the natural expense categories. So in the notes to the financial statements, entities will then need to disclose for the SG&A caption, for example, what any other items are that don't fall into purchase of inventory, employee compensation, depreciation, intangibles amortization, or DD&A. And then as a final key disclosure, the board requires entities to define selling expenses in the SG&A expense line and disclose the total amount of those selling expenses. So on the next slide, we have an example of one of these disclosures that is going to be prepared under the new disaggregation principles or standards that were issued under the DICE project. So on the slides, we have an entity that generates revenue from both manufacturing products and providing services. And in their income statement, they have 3 relevant expense captions. That's cost of products sold, cost of services, and SG&A. And within those expense captions, they contain a variety of those natural expense categories that the entity then breaks out in a separate tabular format, which is on the right-hand portion of the slide. So as you can see, for the cost of products sold expense caption, there is purchases of inventory, employee compensation, depreciation, intangible asset amortization, and then an other cost of products sold category. For cost of services, there's employee compensation, depreciation, intangible asset amortization. And then for SG&A, there's also employee compensation, depreciation, and intangible asset amortization. So a quick note before I move on from this example, the purchases of inventory disclosure can be done in 2 ways. First, it can be done using a cost incurred approach, which would be the cost capitalized in inventory plus any costs immediately expensed during the period. Or it can be done in an expenses incurred approach. And which approach an entity chooses will determine whether there are these additional reconciling items in their tabular disclosure. So if the entity chooses the purchases of or the costs incurred method, they're going to have to then have reconciling items that get these costs to the expenses that are actually reported in the income statement, because obviously not all costs are expensed during a period. And with that, I'll jump to the next slide, which will provide a brief overview of what those qualitative disclosures would look like for the other categories. So in this example, I'll just touch on the first category that relates to the other costs of products sold. And as you can see, this entity explains in this note that category primarily relates to cash that has been paid to carriers for freight services that are related to the fulfillment of their contracts and deliveries. So the final element of this update that I'm going to talk about is this one-stop shop approach. It doesn't necessarily have to do with the actual tabular format disclosure, but there are a variety of rules currently in GAAP that require entities to break out particular expenses that appear in an aggregated expense caption. So some common examples are when entities have PPE impairments or there's a warranty expense. And so what this standard does is it consolidates all those disclosures into one place by incorporating them in that tabular disclosure that breaks out the expense captions by their natural categories. So as you can see here, this is the same example, except it's been updated to assume that the entity has a warranty expense in the period that relates to cost of products sold and an impairment of PP&E, in the period that relates to SG&A. Next slide, please. Yeah, thank you. And so with all these updates coming, the board is cognizant that a lot of these changes will require a lot of effort on the parts of preparers. And so they did a couple things to ease the implementation costs. So first, they limited to the definition of selling expenses to annual periods. However, they felt that having all these other disclosures in interim periods was important because analysts and investors like to update their forecasting models on an interim basis. But the board decided not to require a retrospective application. Instead, entities can apply these updates on a prospective basis. So that wraps up the disaggregation of income statement expenses project. The next one on our list today is the income taxes disclosure project, which again relates to disaggregation. So similar to the disaggregation project related to the income statement, investors indicated through various outreach that they would appreciate more disaggregated tax information, particularly disaggregation by tax jurisdiction. And so the board had a project on their agenda related to income taxes, but this feedback forced them to shift and focus on increasing transparency by updating the rate reconciliation table and providing new disclosures about income taxes paid. So for the rate reconciliation, the new guidance requires an annual reconciliation on both a percentage and dollar value basis. Now, this is different than the prior requirements that allowed entities to provide their rate reconciliation on a rate or dollar value basis. Further, the new guidance requires public business entities to disaggregate their reconciliations into the following categories: state and local income tax effects, foreign tax effects, effects from enactment of new tax laws, the effects of cross-border tax laws, effects of tax credits, changes in valuation allowances, non-taxable or non-deductible items, changes in reserves for uncertain tax positions, and finally, the effects of any additional reconciling items that do not fall into one of those categories. Now, within the state and local income tax effects category, entities must provide qualitative disclosures of the jurisdictions with the largest effect until over 50% of the effect is qualitatively disclosed. And within the foreign tax effects, cross-border tax effects, tax credits, non-taxable, non-deductible items, and other reconciling items categories, entities must further disaggregate and disclose separately any single item that has an effect greater than 5% of the entity's estimated tax liability. So for these single items, entities must provide their disclosure by nature, i.e. by transactions and circumstances that gave rise to the item. Except for items in the foreign tax effects category, for those items, entities must disaggregate and disclose by nature and by jurisdiction. Notably, these new reconciliation requirements are only required for public business entities. Non-public business entities only need to provide qualitative disclosures for each reconciling category and significant items within. Thank you, Rose. So this slide provides an example of the rate reconciliation. It's provided for a multinational company that's domiciled in the US. A few things I want to highlight before moving on. As shown, each of the categories is separately disclosed, even if there is no tax effect for a given category, like the effects of changes in tax laws or rates. Also, there's a separate breakout of individual reconciling items by nature and jurisdiction in the case of the foreign tax effect. for all items that exceed the 5% threshold, which in this case would be $5,000. Last, the disclosure provides the reconciliation by amount and percent, which differs from prior guidance that only required reconciliation by either amount or percent. So in addition to that rate reconciliation, entities are going to have to do these income taxes paid disclosures. The amendments require all entities, public and private, to disclose on an annual basis income taxes paid disaggregated by federal, state, and foreign taxes. Further, within the state and foreign categories, entities must further disaggregate income taxes paid to individual jurisdictions based on a quantitative threshold of 5% of total income taxes paid net of refunds received. The table at the bottom provides an example of what this disclosure might look like compared to the old disclosure. And as you can see, there is quite a bit more information now. So in addition to the primary disclosures aimed at disaggregation, the board made a handful of other small changes. The board eliminated the requirement for all entities to disclose the nature and estimate of the range of the reasonably possible changes in unrecognized tax benefits balance over the next 12 months. The estimate did not conform to the new disclosure principles in the concept statement, and feedback indicated the estimate was generally not decision useful to investors. The board removed the requirement to disclose the cumulative amount of each temporary difference when a deferred tax liability is not recognized because of the exceptions to deferred tax recognition related to subsidiaries and corporate joint ventures, often permanently reinvested foreign earnings. With the changes under the TCJA, this broadly removed repatriation taxes, and these disclosures became less relevant. And then finally, to align with the SEC guidance, the board incorporated the requirements to disclose pre-tax income from continuing operations disaggregated between domestic and foreign income and income tax expense from continuing operations. Importantly, this is different from the income tax paid disclosures on the last slide. So to adopt these updates, the board did not require retrospective adoption, but made it an option for entities to apply, again, trying to reduce the cost of implementation. The amendments are going to be effective for public business entities beginning after December 15th, 2024, and all entities a year later. However, early adoption is permitted. And with that, I will turn it over to Jeff to take us to our next polling question.
Okay, thanks, Derek. Our next polling question is about the recently completed projects and issued accounting standards updates, a couple of which we've just covered, a couple of which we're about to cover. Choose one. Which of the recently completed projects are you interested in conducting research on or teaching to your students? As you're answering that, Jill, I believe that you have a question to answer.
I do. So a question that came in is, how will the new and improved conceptual framework affect current GAAP? So the short answer to that question is it will not affect current GAAP. The conceptual framework is a tool that the board uses when it is doing its standard setting discussions, and it is non-authoritative. So there will be no impact on current GAAP. However, we hope that as the board moves forward with projects that they are currently deliberating, the new conceptual framework will be used as part of the deliberations on a go-forward basis. So we hope to see that discussed, in the future.
Okay, terrific, Jill. All right, let's push out our answers here, and then we'll go on to the other couple of recently completed projects. And you can see it's the one that got the most was the disaggregation of income statement expenses, soon to be final, GUESS 6 final standard. Okay, with that, I'm going to turn it over to Lauren Motley, who's going to talk about segments.
Hi, thanks, Jeff. Good afternoon, everyone. Just a little refresher, this slide here is an illustration of the current segment disclosure requirements. And today, public entities are required to disclose segment revenue, a measure of segment profit, segment assets, and certain other information such as interest expense and depreciation if those items are regularly provided to the chief operating decision maker or included in the measure of segment profit. In addition, those amounts must be reconciled to their corresponding consolidated amount. These requirements have not changed much since FAS 131 was issued in the mid-1990s. And for years, investors have requested improvements to the segment disclosures. Many investors have asked for more columns or finer partitioning of segments, and many have asked for more rows or more line items about each segment, which is why in 2017, the board added a project to improve segment reporting. So in the update, there is a number of key provisions. The amendments require that a public entity disclose significant segment expenses that are regularly provided to the chief operating decision maker and that are included in the reported measure of segment profit. This is what we recall to as the significant segments principle. In addition, other segment items is equal to the difference between segment profit and segment revenue, less the segment expenses that are disclosed under the principle, and you're required to disclose a description of the composition. The guidance also clarifies that entities with a single reportable segment must provide all of the segment disclosures. And if a CODM uses more than one measure of a segment's profit, the amendments clarify that those measures can be disclosed, provided at least one of the measures is one that is most consistent with GAAP measurement principles. And finally, the amendments require that a public entity must provide all of the annual segment disclosures on an interim basis. So this slide is an example or an illustration of the significant expense principle. So moving from left to right, segment expenses that are regularly provided to the chief operating decision maker and are included within the reported measure of segment profit and are considered significant will be disclosed under the principle. Consequently, expenses that are regularly provided to the CODM but are insignificant or maybe outside of the measure of segment profit are not required to be disclosed. So this slide illustrates the types of additional disclosures that the board hopes will result as of will be a result of applying the significant expense principle. In this case, you can see that cost of revenue and research and development and non-manufacturing payroll expense will be newly disclosed because they're captured by the significant expense principle. And this illustration also shows the disclosure of other segment items and a description of the composition of that component. The amendments under the update will be effective for annual periods beginning after December 15, 2023. So I might turn it back to Jeff. I think we've got polling question number 9 here.
Thanks, Lauren. As we prepare for Lauren to talk about crypto assets, we have a fun question for you. And that is, what's your level of familiarity with crypto assets? Very familiar, somewhat familiar, not familiar, or none of the above? So as you answer that, I think, Derek, you have a question to answer?
Yeah, thanks, Jeff. So we had a question come through the Q&A chat. With the increased focus on disclosure, is the FASB thinking about providing further guidance on how to think about disclosures from a materiality perspective? This would include materiality of elements of disclosure individually and in aggregate for a topic. So great question. I think for the current projects that we've talked about today, where the FASB is requiring more disclosure or disaggregation, the standards themselves have embedded principles about when to disaggregate. For example, in the disaggregation of income statement expenses, it's whenever these items appear in an expense caption. For income tax disclosures, it's 5% of an estimated tax liability. Now, this obviously is not to say that this overrides the general definition of materiality when it comes to financial statements. If something's above that threshold but would be deemed immaterial, then an entity, of course, would not need to make that disclosure.
Okay, terrific. Let's push out our responses here. Okay, and you can see what those are. Most people either only somewhat or not familiar as opposed to very familiar. Okay, back to Lauren to talk about our recent standard on crypto assets.
That's good to know that the audience is not particularly familiar, so hopefully this will be informative. So with regards to the new ASU, the reason for it was issued is that many stakeholders have noted that the current accounting does not provide users with decision useful information, noting that the current intangible asset accounting model doesn't really do a good job at reflecting the economics of crypto assets because the model only really reflects the downside adjustment and doesn't allow for an entity to write back up the value if it recovers. The lack of crypto-specific accounting guidance has also resulted in different interpretations that could lead to restatements. So the FASB issued ASU 2308 back in December, and it really addresses accounting and disclosure for certain crypto assets. The guidance applies for both public and private companies. The board intentionally kept the scope of this ASU narrow to address Bitcoin type assets that stakeholders indicated were really of the greatest concern. The proposed guidance applies to crypto assets that meet 6 criteria, as you can see on the slide. Number 1, the item meets the definition of an intangible asset. Second, the item does not provide for enforceable rights to or claims on underlying goods, services, or other assets. 3, the item creates or resides on a distributed ledger based on blockchain technology. 4th, the item is secured through cryptography. 5, it is fungible. And 6, the item was not created or issued by the reporting entity or its related parties. So in terms of measurement guidance, the crypto assets that are in scope of this ASU are required to be measured at fair value using the guidance in Topic 820, which requires fair value increases and decreases to be reported in net income each period. Under prior guidance, crypto assets were measured at historic cost and subsequently evaluated for impairment. These impairment losses are recognized in net income, but the gains were only recognized when there was an actual realization. The accounting guidance under this new ASU better reflects the economics of the transactions and demonstrates the volatility of crypto assets, and it allows for the recovery of impairment losses. Additionally, the fair value measures for these assets are often already reported in the MD&A section. So this guidance really standardizes the information within the financial statements. And finally, some stakeholders also noted that it would help reduce the cost of preparing financial statements. So in certain decisions around the presentation of where the changes and balances are going to be reflected. So for the crypto assets that are in the scope, they will be required to be presented in the balance sheet separate from other intangible assets. The gains and losses on these crypto assets should be included in the income statement separately from other income statement effects of other types of intangible assets. And finally, generally Topic 230 on the statement of cash flow applies. And in a specific instance, crypto assets that are received as non-cash consideration during the ordinary course of business and are nearly immediately converted into cash should be treated as an operating cash flow. And in terms of the disclosures, there was a number of important disclosure improvements that came through this ASU. Just briefly, some of these is that for each significant crypto asset holding, companies will be required to disclose the name of the crypto asset, the fair value, the number of units held, and the cost basis, both on an annual and interim periods. On annual periods, a reconciliation activity will be required between the beginning and the ending of balance for total crypto asset holdings. So this reconciliation will require an entity to disaggregate information based on additions, dispositions, gains, losses during the period, and will require a description of those additions and dispositions. Also on annual periods, the difference between the sale price and the cost basis of crypto assets that were disposed of in the period will be required. And fourth, the fair value of the crypto assets that are restricted from sale and the nature and the remaining of any duration of the restriction and the circumstances that could cause a lapse will be required on both an interim and an annual basis. In addition to these specific disclosures, the board was clear that the disclosures in topic 820 on fair value measurement will also be required. The intention of this is that hopefully these disclosures will help provide a more comparable, decision useful set of information so that users can assess the measurement uncertainty related to these types of crypto assets. And finally, on this slide is about transition and effective date. So the board decided that early adoption will be permitted since the current accounting model is particularly costly for preparers and doesn't provide the most decision useful information. The board also decided that the cumulative effect adjustment will be made to retain earnings will be recognized at the beginning of the annual period in which the entity adopts. The board also decided that all entities, including non-public entities, should be subject to the same effective date and transition requirements, and that the guidance will be effective for fiscal years beginning after December 15, 2024, and interim periods within those years for all entities.
Okay, so we have our next polling question, and that is, how did you learn about today's webinar? And here are your choices: action alert, social media, FASB email, AAA email, FARS email, word of mouth, or other. I think we have one or two questions that my fellow speakers want to answer.
So one,
Hey,
oh,
ahead,
sorry,
Christine.
Derek. You okay?
Yeah, I had trouble getting back on.
Oh, you did. Okay, I'll be very brief. One of the questions that came in was, so is it expected that non-fungible tokens will meet the definition of crypto asset? And the answer is no, because we limited the scope to those crypto assets that are fungible. We, did have quite a bit of discussion about non-fungible tokens, but decided that it was just such a nascent market and nobody was really holding those as assets on their balance sheets. So it just wasn't a pervasive issue. So maybe someday that'll come back if they become more pervasive, but they are not within scope of the guidance that we issued. Derek?
Yeah, thanks, Christine. Great answer. So we got a question from Zane Swanson. How do you see the prospective disaggregation of firm accounting reporting in the calculation of the prospective key performance ratio analyses? So I think you raise a really good point, Zane, that the disaggregation projects are quite aligned with a lot of the topics that the board is considering in the potential KPIs project. So for example, a common key performance indicator is free cash flows. Which disaggregation in the statement of cash flows or perhaps subtotals could make that measure available to users of the financial statements within the actual financial statements, as opposed to a disclosure outside of firms' annual reports.
Okay, thanks, Derek. Let's push out these answers, and I'll turn it over to Christine, who'll talk about some other recent standards. Here we go. Lots of folks heard about this through emails received from the FASB and then from some various other sources. Now, with that, let me turn it over to Christine.
Thank you. Having a little mouse trouble getting getting myself back off mute. All right. So in addition to the ASUs that we just covered, there are several others that were issued in 2024 and 2023 that I'm just going to briefly go over. So in 2024, we issued 2024-02, which systematically removed references to the conceptual framework from the codification because the conceptual framework is intended as a decision-making tool for the board and is non-authoritative. We also issued Update 2024-01 that added several examples to demonstrate how an entity should apply the guidance to determine whether a profits interest award should be accounted for as stock-based compensation. And then also we have Oh, sorry, just if we go back to the previous slide for 1 second, I will just mention that coming soon, we have a very narrow scope set of guidance that will be coming out dealing with the accounting for induced conversions of convertible debt. So you can also watch for that one. All right, next slide. Thank you, Rose. In 2023, we issued Update 2023-05 to address diversity in the measurement of contributions received by a joint venture upon formation in the joint venture's financial statements. And the amendments require that newly formed joint venture to initially measure assets and liabilities at fair value on the formation date, consistent with the business combinations guidance, regardless of whether the contributions to the JV constitute a business in accordance with the definition of a business in subtopic 805.10. This approach results in an accounting outcome that is like the outcome that would be achieved by treating the joint venture as the acquirer of a business. We also issued ASU 2023-02, which extends the optional application of the proportional amortization method for low-income housing tax credit investments to additional types of tax credit investments, such as structures involving new market tax credits, historic rehabilitation tax credits, and renewable energy tax credits. Under the proportional amortization method, the initial cost of the tax credit investment is amortized in proportion to the income tax credits and other income tax benefits that are received under the investment. And the income tax credits and other income tax benefits that are received, net of the amortization, is presented in income tax expense. Now, before Update 2023-02, only investments in the low-income housing tax credit structures that met certain criteria could qualify for that specialized approach. Under Update 2023-02, entities can opt to apply that proportional amortization method to any type of tax credit that meets those criteria, or investment tax credit investments that meet those criteria. The new guidance is intended to ensure that similar economics are accounted for similarly. We also issued Update 2023-01, which addressed 2 issues. First, it added a practical expedient to Topic 842 leases for private companies and certain not-for-profit organizations to use the written terms and conditions of any lease arrangements that are between entities under common control to determine whether a lease exists, and if so, how it should be classified, without having to determine the legal enforceability of those terms and conditions. Second, for all entities, including public entities, that update amended the amortization period for leasehold improvements associated with common control lease arrangements and requires that the amortization of those leasehold improvements be done over the economic life of the leasehold improvement, regardless of the lease term, as long as the lessee continues to use the underlying asset. So a complete listing of issued ASUs is accessible on our website. And finally, this last slide provides a link to, actually, I don't see the link there, but it does state that there is a listing of all of the effective dates for all of the updates on our website. And with that, I think Jeff wants to talk about our next webinar.
Yeah, I want to give a not so shameless plug to our follow-up webinar that we hold each year. That's focused on specifically on for academics who teach governmental and nonprofit accounting courses. And this year, it'll be myself, Jeff Cabello, who's a supervising project manager here on our not-for-profit team, and Tammy Waymeyer, the GASB's senior research manager and former academic. Well, together we will be presenting an update on the activities of the GASB and the activities of the FASB as they affect not-for-profit organizations. We'll be talking about current issues that you might find useful in your teaching, as well as in your research. And encourage those of you who teach these courses or have colleagues who teach these courses to keep an eye out for the registration, which will be on our website by the end of this month. With that, we have one more polling question. And then we need to stay on at least till probably about 3:08 or so, a few minutes past 3:05, our scheduled 3:05 start time, just to make sure that you all get your full 2.5 hours of CP credits, again, provided you've answered questions and so on. So our final polling question is, at which points, and this is select all that apply, during a project's timeline, are you likely to discuss the project with your students? During initial deliberations, when a proposed update is issued, during redeliberations, and/or once the final update is issued. So as you answer that, we'll see if any of my fellow speakers have any questions they'd like to answer.
So I can answer a couple. So one of the questions that we got was, how did the board consider the cost benefit calculus with respect to the disaggregation projects, such as the income statement, the income statement expense disaggregation project and the tax disclosure disaggregation. So, you know, I can only speak for myself as a board member, obviously, but for me, the feedback that we receive from investors on just how important the additional information is to them and how it's going to allow them to do a much better job of forecasting future cash flows and making investment decisions, that was very consequential to me. And those benefits are not just going to be in the year of adoption, they're going to be ongoing. So for all time, they're going to get this better information. And so they're going to continue to reap the benefits. On the cost side, particularly with DICE, we did appreciate that the cost of implementing the guidance could be significant for some companies, but it's a one-time cost. And so, you know, I think once you sort of compare the ongoing and significant long-term benefits to the one-time potentially significant cost, that weighed quite heavily. And then last but not least, we made a number of changes when we were creating the guidance in order to try to reduce the cost of implementing the guidance, which means that investors didn't get everything that they wanted. There was quite a few things that we didn't go forward with because we were trying to be sensitive about cost.
Great, thanks, Christine. We got another question from the audience. Does the FASB have a plan to address the accounting for transactions with non-financial receivables, or more broadly, transactions with non-financial obligations? And I think what the participant is getting at here is the accounting for things that fall under the broad umbrella of ESG. And so ESG is definitely a new area. We're learning a lot about how to account for things that relate to ESG. And there's resources on the FASB's website that I encourage people to try and find, particularly a FASB staff document that talks about how all these different topics may show up in GAAP already. Again, because to the extent that any of these ESG items or initiatives have a financial effect, they will show up in the financial statements. It's just a matter of when and whether it's clearly identified. And so I think there's a lot that I think that the staff and board is continuing to learn about ESG and how to make that information more digestible for investors. And then there's also a bunch of different organizations out there that are taking on the task of creating ESG related standards. So for example, the International Sustainability Standards Board, and then there's the Environmental Financial Reporting Advisory Group that was instrumental in the new European Union requirements for their sustainability disclosures. So I hope that answers your question. But again, I think we're all learning in a really new space.
I think it'll also be interesting to see what comes up in the agenda consultation as well, because that agenda consultation is going to really set the stage for what the board is working on, you know, over the next 5 years or so. So I was thinking, Jeff, unless there are other questions.
Lauren may have one that she wants to answer.
Yeah.
Yeah, and I think one came in the chat, Christine, that you would also, I think,
Okay.
as well.
So the question, do I believe that the proposed grants accounting is consistent with the principles underlying accounting ASC 606? So no, actually, that is my concern. And it's not just my concern. Some of the feedback that we received during the ITC was that the income recognition principles that underlie IAS 20 are not consistent with the income recognition principles that underlie topic 606. So we've moved to a performance obligation type model when it comes to the accounting for revenue. But for the grants related to assets, the grant income recognition is matched to the asset depreciation. So it's not like once you've satisfied the obligation under the grant, you record it as income. Instead, even if you've done that, you just take that grant income into income over time, consistent with how the underlying asset is being depreciated. So it's a matching principle approach.
Okay, terrific. Let me ask Lauren to answer her question, and then we'll wrap up the webcast.
Sure, thanks. I got a question here about, isn't the scope of digital assets much broader than the scope that's described in the ASU? I think that's very similar to the question that Christine answered earlier, but just figure I'll reemphasize. Yes, the board was particularly narrow in selecting the scope of the types of crypto assets or within the guidance. In particular, the board was very specific about the fungibility criteria of the scope of that, of assets that would fall within that guidance. I did have another one, segments by, Jeff, do you want to, I can turn it back to you.
One more, you can go ahead.
Sure. We got another question in here is, when will companies start reporting the new disclosures, the new expense disclosures? Just firstly, number one, the guidance was only issued back in December of 2023. It is early adoption is permitted, but it is effective as of December 15 for financial years beginning after December 15, 2023. So companies will start reporting that in the December 2024 financial statements. So you should be able to start to see that and potentially start doing research and teaching that to your accounting students starting in 2025.
That's great. Let me just respond to one question. It's what resources such as PowerPoints, recording, and so forth are made available to attendees and those who could not attend due to work issues. I'll repeat what I indicated earlier, that the PowerPoint slides, and they are in PowerPoint, are available on the FASB's website. We put a chat link earlier on this, and again, it's on the FASB's website. The news and meetings drop-down menu, and then there is educational webinars. That's where you'll find that, as well as where you'll find a recording of this session. You won't get CPE credit for listening to the recording, but again, for colleagues who weren't able to make it, it's a valuable resource. And with that, I think I'll turn it over to Christina for some closing remarks.
Thank you, Jeff. Well, I just want to finish up by thanking you all for spending some of your valuable time with us today to learn about what we're working on and what we've recently completed in terms of accounting standards. I would always like you to know that we are open for business when it comes to research that you're working on that's relevant to topics that we're working on. Please do share that research with us through the submission portal on our academic landing page. You are also very welcome to reach out to me at any time if you have questions, or to our postdoc fellow, so to Derek. And we will either answer your question to the best of our ability or make sure that it gets passed on to someone who can answer it. The last thing I guess I would say is just a plea that we are going to have up to 11 documents out for public comment during the fall and into the new year. And some of those are they're all very important, but some in particular, because of their implications for the future, like the agenda consultation, ITC, just take a look at those. And if you do have thoughts, opinions, research that's relevant, do participate in our process by submitting a comment letter. It's really important. It helps us a lot. So thank you very much for your time today and stay in touch.
Thank you all.